Uber Eats really became Grab Food. And that's how we started the delivery business. And then we had COVID and so on. We added more products, grocery delivery, and they just continued to evolve. Now, the fintech side of the business is quite unique because that really came out of necessity because it was very much a cash-based society, Southeast Asia. And we needed to solve cashless. And how to do that is to really build this fintech capability in Southeast Asia, where we built digital wallets, payment services, and that's how we started first. And then we evolved to micro lending because we were building an ecosystem around it. So it took time.
Hey folks, today Daniel and I have a very special episode following up on a company that was pitched just a few weeks ago on the podcast, and that company is Grab, Southeast Asia's leading super app. And the person we'll be speaking with is none other than Peter Oey, Grab's CFO, and with roots in ride-hailing and an expansion into a really comprehensive ecosystem of delivery, mobility, and financial services, Grab has become an essential operating system for daily life across the region. And Grab is often compared to Uber, one of our favorite companies, but they differ in some important ways. And actually, it was Grab who won Uber's market share in Southeast Asia ultimately. So it's a company that has truly defied the odds in every manner and found innovative ways to bring a sophisticated set of consumer apps to emerging markets that are, well, much messier to navigate than the US and Europe, from different regulations across 8 countries to extremely dense traffic and just generally more informal economies. But with that backdrop, Peter, welcome to the show. It's a real honor to have you here. Maybe you can just take a moment to describe your business for the audience.
Thank you. Yeah. Hey, Shawn. Hey, Daniel. Great introduction. So let me just continue, tag along that. So we just celebrated our 14th year birthday as a company. Really excited of what the next 14 years is going to be. We started as a ride-hailing company back then. Think of it, ride-hailing taxis. That's how we started in a city called Kuala Lumpur. And what we've evolved today is a super app in Southeast Asia with 52 million monthly transacting users. We have 9 million daily transacting users on the platform. And very engaging. So what are the people doing on the super app? Yes, we have mobility services, ride hailing. So you order a car, 2 wheels, 3 wheels, 4 wheels, many wheels. That's what we do in Southeast Asia. People, we have all forms of transport. And then we also do deliveries. Now, whether it's food delivery, whether it's grocery delivery, if you want your parcel shipped. So anything on demand that you need to get to a point to point, we do also throughout Southeast Asia. And then we have a unique, something which is a little bit different to some of our peers. We have a financial services business, which is really providing digital payments, digital wallets. And also we have micro lending to drivers, merchants, and consumers. And then we have 3 digital banks. They're all in one app, so to speak, where people are just engaging. So to give you a bit of context, we're in 900 cities throughout Southeast Asia in 8 markets. So that's Grab.
Well, Peter, first of all, thanks for being here, and also happy birthday to Grab, of course. You just discussed basically the evolution that Grab took as a company. What I would be interested in is how exactly did Grab go from MyTeksi in the beginning in 2012 to this, super app, which is valued at, $14 billion that Shawn and I looked at just a couple of weeks ago. And I would really be interested in what was the vision for the company back then, and how did you follow up on that? And when did you see that this could become something much bigger than just MyTeksi?
Yeah. It's funny because when we started the business, and I can't speak for myself because I didn't start it, it was Anthony Tan, our founder and CEO. Back then, it was really solving for safety for women. That's how it all started. When he was at the business school, Harvard, he had a vision with our co-founder, Hoi Ling at that time. And then there was a problem statement where in Southeast Asia, especially in Malaysia at that time, it was very dangerous for women to catch a taxi in the evening. And that was a real problem statement from our co-founder. So Anthony said, we have to solve this. So that's how he started the taxi ride-hailing service. And matching between taxi drivers at that time and also passengers. And at that time, mobile penetration was still quite early, mobile phone. And a lot of taxi drivers didn't know how to use a mobile phone, didn't know how to use the app. So it was a lot of education. And that evolved to private vehicles. As Uber was taking off, as other ride-hailing services were taking off around the world, we piggybacked on that. And that evolved from 2014, roughly 2012, till about 2016, 2017. It was all about ride-hailing. The turning point was really when we acquired Uber's business in Southeast Asia. So we were fighting head-to-head with Uber. It was a great competition, but we came out victorious on the other side, and we acquired that business. And what Uber developed, Uber Eats really became Grab Food. And that's how we started the delivery business. And then we had COVID and so on. We added more products, grocery delivery, and they just continued to evolve. Now, the fintech side of the business is quite unique because that really came out of necessity, because it was very much a cash-based society, Southeast Asia. And we needed to solve cashless. And how to do that is to really build this fintech capability in Southeast Asia, where we built digital wallets, payment services, and that's how we started first. And then we evolved to micro lending because we were building an ecosystem around it. So it took time. What started was just ride-hailing services, and then we just add on more services because consumers were asking for it, as well as drivers and merchants were asking for those services.
When I looked at other Asian companies and generally companies that operate in emerging markets, one thing that I always found, it was with Mercado Libre, but also with C Limited, is that those companies are incredibly good at understanding their target customer and then adjusting their products to their needs. And now you're just saying that, you beat Uber in Southeast Asia, and we know Uber, we, invested in Uber, and it's a fantastic company, but you beat them. And we know their business model. And we also know that, especially in the tech industry, usually the big companies, they tend to win their market, and they even do it, not only in their home market, but sometimes even globally. So how were you able to beat Uber at its own game without having the scale that Uber at that point had? What made you special, and what did you understand about the needs of your customer that Uber didn't understand?
Yeah, Daniel, it's a really good question, because if you look at our business, even up to today, and even back then more and more, even today, we're a very hyper-local business. And if you think about Southeast Asia, there's 700 plus million people, there's thousands of cities, thousands of languages are being spoken, many provinces, and you just got to be so localized. And I think this is where our advantage was that we came in with a different lens, that we have to really localize our business and make it so hyper-local to every single city. A great example at that time was Uber was you could only use an Uber by taking credit cards. Now, Southeast Asia, credit card penetration is low single digit. Like how people were living on a cash society. And even up to today, believe it or not, about 25% of our transactions are still cash today. And we're still trying to convert into a pure digital cashless society. So I think that just gives you a great example. Another one is how we recruit drivers, for an example. We went very local. We set up shops, we set up driver centers, we recruit people. We have locals doing all the recruiting also. It was a very much localized touch. I think from our perspective, that gave us the edge. And up to today also, we have that advantage across the board.
You just said it. I mean, you're basically operating across 8 countries and over 900 cities. And you just pointed out how localized your operation is. I would still be interested in how even you handle the basically logistical nightmare, all these fractured regulatory environments and regimes in all of those markets, and whether there's a difference between countries that you look at as more emerging markets and then, for example, Singapore, which is a highly developed market, and the different approach that you need to take in those markets.
Definitely. Every single of those 8 markets that we operate in today, and we're about to enter our 9th one, actually, Taiwan, with a transaction that we haven't closed yet. But in each of those markets, we have to really work very closely with the government bodies, and not just at the country level, but also at the city level. And then even we go deeper into the same provinces of those cities, especially in areas of transportation where it is regulated in many, many of Southeast Asian cities, because we are taking the public from point A to point B. So the government's always very concerned. So we're very, very local in building those relationships with the different regulatory bodies. Because if you really come think of it, we're actually co-building with those countries. A lot of the drivers, the millions of drivers that we have, the million of couriers that we have, a lot of them actually came from the informal economy in Southeast Asia. And they came on board. We gave them opportunity. Last year alone, we did $15 billion. We was contributed back to all our partners, our drivers and our merchants in Southeast Asia alone. So we do play a fairly sizable role in Southeast Asia. So we do need to partner with them very closely. And it's really critical. And it's very localized also to its deepest root, where we need to make sure that we are complying with all the rules that they want, but also at the same time, we build the rules together with them, because also they are trying to sort out a lot of the things that we're trying to solve, whether it's transportations in those cities, in those provinces, whether it's food quality, for an example. And then we went to Fintech. That's another a lot of requirements and compliance that we were actually co-building with them and working with them. So certain markets are very strong, like Singapore has very, very strong regulatory framework. And we've used some of those models actually and try to work with those some in other countries also where it's applicable.
Well, so Peter, I would love to dive in a little deeper into the unit economics behind Grab and the super app flywheel. And the flywheel concept is one of our favorite ideas from the author Jim Collins, who I'm sure you're familiar with. And so, when I look at Grab's business, it does seem like the flywheel is accelerating, right? And, one of the stats that has really stood out to me is something like more than 60% of monthly transacting users, MTUs, use multiple Grab services. And so I would imagine, like I said, this helps spin the flywheel. Maybe you can speak more to how this lowers the cost of customer acquisition for Grab over time.
Yeah, definitely. There's a lot of very uniqueness about a super app concept. And the first thing is the CAC costs, how the CAC costs can come down so much, because once they're in your system, once you're in ecosystem, whether you're coming through the mobility funnel or whether you're coming through the food, because it's a super app, you're already using the same app effectively. So what we can do then is you can nudge, cross-sell, upsell all those different services across the board, especially within mobility and food delivery, which is our two core businesses today. So the CAC cost really comes down. There's an initial CAC that you would need to invest in, but then once you're in the funnel, which you spoke about, the 2/3 of our users today are using two or more services today. And most of them are mobility or food delivery of some sort. So that's really important. The other thing which is unique about a super app is the ability for you to collect the data points. Because if you know that someone is taking a ride to a restaurant for a meal of some sort, and you get a sense of a data point that, okay, this particular user either likes hawker food, street food, or they like upmarket food, or they like Thai food, or whatever it is, that gives you a data point. And the data point gives us, okay, I think I'm going to try to sell or upsell or nudge this person for a Thai food delivery because they just went to a Thai restaurant effectively. So that's another data point that we have today. Now, those data points also we could use for advertising in our food delivery ecosystem also. We actually have even mobility, some advertising on that also. So when we know a passenger is going to a shopping mall, we would actually nudge that particular person, hey, because we kind of know what they've been buying, what kind of they've been also eating. We kind of give them, hey, there's an offer in that mall for 20% off if you buy that ice cream or that coffee or that chai tea. Why don't you do it, right? So there's all this cross-selling and upselling opportunity, which is unique. And that's what's really been driving effectively the flywheel for us. If you look at the growth of our revenue and on-demand GMV, as well as the margin, is actually been a lot of those cross-selling. Now, the trick to that is product depth. If you only have just two basic products, it's pretty hard to cross-sell. So you got to have the depth of the product for customers or for our users to keep on trying different things. And that really helps. So one of our big core vision is to actually how to get 2/3 to 80%, 90%. How do you get them to using 3, 4, 5 services in the platform?
It's a really compelling vision. And for anyone who knows me personally, they know that I talk all the time about Uber's flywheel and their cross-selling opportunities and how compelling it is. And I think it's a very similar picture here with the super app flywheel that Grab is building. And, you mentioned this product depth. And, from what I've seen, retention rates for users that engage with 3 or more services is something like 88% versus 37% for single service users. So maybe you could speak more to what kind of specific lock-in mechanisms are most effective for retaining people in the ecosystem. Is it GrabUnlimited? Is it GrabCoins? Is it something else?
Yeah, definitely. So in the last few years, we've added a few things. One is affordable products, and we talk about product depth first. We were initially, when we started the business, and especially pre-COVID, we were really being known as your middle and upper segment of the customers. So we've been really very conscious in really pushing where we could actually go to the mass market. So we built out a lot of affordable products, what we call affordable products, whether it's the food delivery side or even the mobility side, where you're trading off certain things for a lower mobility fare, for an example. So if you're willing to wait a little bit more longer, your car may not be as snazzy as new, and you're willing to live with that, then you can get actually a much cheaper ride, right? But for those who really want the upper ride, you can also pay for that. So that barbell strategies really work. And that really begins the cross-utilization, because once you've taken a ride with us, whether it's an affordable ride, there's always times when you want to actually try that, maybe that middle of the pack kind of product also. Now, in food delivery, what's been really interesting for us is a lot of the delivery offerings that we have on the affordable side are all about delivery fees. How do you actually package a delivery fee where it's lower for the customer? Because that's the highest friction point when it comes to food delivery, certainly in the markets that we operate in today. So if you're not as hungry and you can wait, I'll trade for you a lower delivery fee. Maybe it's $1 instead of $3 or $4. And if you're really hungry, then you're willing to get a priority delivery for a higher delivery fee, and you get it in 30 minutes. That trade-off for us has been interesting to watch, because customers are fluctuating between those two. Because if you're hungry, man, you're not going to wait. I'm going to get that food ASAP. That's $2. I'm willing to pay for it, right? So there's that trade-off that the customer. So we've used a lot of data, those data points, to really help customers steer their behavior also in terms of how they're doing the food delivery. And we just added a new product called Group Order, where imagine that if you're in an office environment, there's 10 of you, and we use it a lot in the office. There's 10 of you fully ordered together. You're effectively amortizing the delivery costs of that one batch of delivery to hardly anything, like 10 cents, 20 cents, right? So we can really brings it down completely. So all those different data points for us has helped to put the retention into the super app itself. The other part that we've been adding is loyalty. So we do want customers to be loyalty, and we're willing to actually trade some things with them. And part of it is our GrabUnlimited, which you spoke about, which is Southeast Asia's biggest loyalty program, which is, so a third of our user base today is on this GrabUnlimited. And for us, actually, it's less about the subscription fee. It's less about that for us. We make it so cheap for them. It's a no-brainer type. But actually what's behind those programs. So your delivery fees come down considerably. You get a lot of benefits. And recently we just added GrabCoins, which is like, we give you points, right? The more you fly, the more points you get in the airline. Same thing. The more you buy from us, we'll give you coins. And those coins you can trade for cash. You can buy things. You can actually, because we're a super app, you can do a lot of things with those coins. You can get a free ride, you can get free food for your meal, you can get some groceries. You could go, because we have Grab Pay, which is a payment service like Apple Pay, you can go to a store and buy something using GrabCoins. So it's actually made that stickiness even more powerful for us throughout the life cycle of a customer.
Well, it's an incredible ecosystem that you're building. And I really love the saver idea in particular, because, it's a win-win all around, right? From the customer side, you either pay with your time or with your money. And I don't think there's a right answer to that, right? Everybody has a different perspective on that based on their financial situation or how much time that they have. And from Grab's perspective, it's a great way to increase order frequency and density, which is, hugely important to the unit economics. As you said, you're kind of amortizing the costs over more orders, and that's essential to it. But Daniel, I know you have some fintech and digital banking questions, so maybe we should jump to that.
It's almost an inside joke by now that I tend to have a weakness for payments businesses, especially if they are part of a flywheel with these very strong ecosystem companies like Grab, for example. So I kind of hope that you will give me a bit more insight into, first of all, your general financial services business. And then maybe you can also talk a bit about the banks. I know that you have 3 different banks and they're also in different countries. So one of them is in Malaysia and Singapore and Indonesia. And there are a lot of companies that I looked at that are using, a fintech side of the business to strengthen the flywheel. I talked about Mercado Libre. I talked about Limited, for example. And both of them seem to also want to go into the banking direction. It appears that you are a bit further on that route. So maybe you can give us a bit of an insight for why you use the fintech business, how it strengthens the flywheel, and then also give a bit of the insight on how you think about the banking part of the business.
Yeah, no, definitely. Because when we started the fintech, was really what I was saying earlier, was really to solve for this cash society, to a cashless society. And we built all these payment rails. It also helped us actually from a cost avoidance perspective, because since we built the rails ourselves, we could drive the cost of funds down, especially for payment transactions. And so when you open up the Grab app today, you will most likely create your own wallet, digital wallet. It's kind of by default, actually. So you're walking around. So you got 52 million monthly transacting users, or even 9 million users that's walking around with your phone with already a digital wallet pre-installed in your app already, effectively, because they don't have credit cards. Again, Southeast Asians are not known for using credit cards. So you need some sort of mechanism to make payments, and using our services also requires you to have a Grab wallet. So with that itself, what we've been doing is collecting data. Right? Again, going back to one of the key assets of a super app is the data that you collect. Alex, my chief operating officer, always jokes to me, Peter, you know that we're a data science company, right? We're like, I know, like we do ride hailing, we do food delivery, or we do fintech, but we're actually a data science company. And the more I think about it, I think he's right, because it's actually the data that we're collecting behind the scenes. And the evolution of our financial services business actually goes back to the data that we've been collecting. So the data that we've collected has given us confidence to give out loans.
Yep.
So we are able to, and we started actually very different to some of our peers. You spoke about Melly and C, where they started on the consumer side. We started on the driver side because we felt that we have the most data is on the drivers. We have their wallet. We know how much they earn. We know how many hours they work in a day. And I'm able to see who's more efficient as a driver, because we also have our own mapping stack that we own. Well, we get to see the driving behavior of a driver also. That gives us signals in terms of how do I underwrite a loan to our drivers. So when you look at driver lending today, about a third of our drivers take lending with us, and it's been one of the most successful lending products that we have. The other benefit of that is stickiness on the platform, because these drivers, when they have a loan with us, and it was strange for me to watch the data, is that their efficiency is higher. They're more efficient on the road for whatever reason. And they're sticky. Their retention is higher on the platform also, which is really, really important. And they're earning more on the platform. So there's this behavioral that actually, if you take a loan with Grab, you're actually earning more on the platform, which is really fantastic. So we start on the driver side. And where we are today actually are on the merchant side. So we're actually now building the capability, strengthening that to actually offer loans to the millions of restaurant merchants today. Because a lot of these folks, whether you're a driver or a merchant, the alternative is not great because they can't get credit. That's the whole fundamental, is that they're completely underserved. They can't credit because there's no history for these folks. I'm willing to underwrite them because I have the data. Hence why we actually are willing to go in and give them these loans, because we feel confident. Now, you're probably saying, why have banks, right? You can do all these things now, Peter, without a bank structure. You're right. But when you think about it, we are today, all the loans are on our balance sheet. So there's so much that you're willing to actually leverage your balance sheet to do that. This is where the banks came in from a cost of capital perspective. And the banks that we've developed, given us a much more leverage in terms of cost of capital. And the other thing is for these banks is also that they can just write bigger ticket loan items that we can't if you're actually using them by own balance sheet. right? So they have the ability to do that. So part of that is just graduating for these drivers from a small loan that starts with Grab, and then they get graduated when they open up a bank account with our banks, and then get a bigger loan, ticket loan, and potentially a car loan to go with that. So it's that evolution of just lifetime value of a driver, a merchant, or a user using all that different aspect of our financial services.
If you're a fundamental investor like me, you need a research terminal that actually keeps up with you. That's why me and my colleague Daniel Monka use Fiscal AI for every episode of the Intrinsic Value podcast that we do. It's the complete stock research terminal built for people who care about the numbers. Fiscal AI pairs a modern interface with institutional grade data. It has over 20 years of financial statements, 40 quarters of history, and company-specific segments and KPIs that I love digging into. You want Google's cloud revenue? It's there. You want to see Duolingo's monthly active users? It's there. And I know because we did that in our episode on Duolingo. There's millions more data points too, all updated within minutes of earnings, not days later like legacy platforms. You can export data, run screeners, pull earnings call transcripts and Morningstar reports, track super investor holdings, and compare companies head to head, just like me and Daniel do, and even plug Fiscal AI into Claude to power your AI research with institutional quality data. Head to fiscal.ai/TIVP. You'll get 2 weeks off Fiscal Pro free. And if you upgrade, that same link will save you 15% on any paid plan. Again, that's fiscal.ai/TIVP. Hey folks, quick but exciting update here. On Saturday, September 19th, Daniel, Kyle, and myself will be hosting the Intrinsic Value Conference, New York City. This will be a full day of value investing talks, stock pitches, and panels in Midtown Manhattan as part of a bigger weekend with our mastermind community from September 18th through the 20th. And we're hoping to make it something like ValueX and TED Talks combined. And so members of our mastermind community, both the Inner Circle and our Intrinsic Value Mastermind, will have spots reserved at the conference as part of their membership for free, plus private community dinners on Friday and Saturday night and breakfasts on Sunday. And for everyone else, there's 2 ways you can join us if you're interested. A general admission ticket gets you full access to the conference itself, a stock pitch presentation from Kyle and an intrinsic value portfolio with Daniel and me, plus guest speakers that we'll be announcing in the coming weeks. Or if you want the full experience, our VIP ticket package, that gets you all day conference access, plus a seat at our Saturday night exclusive dinner with William Green and the rest of our Inner Circle community. And it will definitely be one of the more special evenings we host all year. So if you've ever wanted to spend a weekend talking shop with serious investors in the financial capital of the world, this is it. Find tickets and the full agenda at theintrinsicvalueconference.com. That's theintrinsicvalueconference.com. And if you'd rather join us as a member and get the conference plus the full weekend included, apply to the Intrinsic Value Mastermind at theinvestorsspodcast.com/mastermind-application. All the links are in the show notes below. Hope to see you in New York.
I actually love that approach. Part of why I don't like banks is because I basically work with the same data as everyone else. And the great thing about businesses like Grab, for example, is that they can lend money to people that before that didn't get a loan because they have data points that no one else had. And especially using that on the merchant side helps a lot. And for you, it's, for example, the driver. I do ask myself, though, if I look at a company like Melly, for example, I get a whole lot of data points. So they give me a net interest margin on the loans. They give me an NPL, so non-performing loans. When I listen to your earnings calls, it's mostly that you say they stay within a certain risk appetite. So I would be interested, what is that risk appetite and how do you see it changing over time? Because I could imagine that your NPLs might look pretty good, especially if you mostly go for the drivers and the merchants, because the consumer side tends to be more risky.
Yeah. And part of the why and our disclosure is improving when it comes to financial services is we're in this inflection point of our business today, where you see the loan book scaling. We're at roughly $1.5 billion of loan book size now. And we disperse roughly about 1.1 billion a quarter. So you can see these loans are being recycled pretty quickly, pretty rapidly also as part of it. We do say NPL is below 3%. So, and that's been pretty consistent every quarter for us because our risk appetite is guarded. We use guardrails for that. As the loan book continues to grow, our plan is to disclose a lot more in terms of the returns that we get from every of these loans. As a high level, to give you a bit of a sense, what today that we use as a key guardrail is all those loans that we do has to return above our average cost of capital, which is a really critical benchmark. So NPL is a great benchmark that we use, cannot go above 3, and it has all the loans have to be returned above our average cost of capital. Especially if you're at the bank side, the average cost of capital actually gets more attractive because you have customer deposits also on the other side. So that's the plan, but we're really excited because we're in this really interesting inflection point now as we start to go to consumer, because I think consumer is the holy grail. I do believe that. And I've seen it with some of those names that you mentioned before. But also we want to make sure the risk appetite is also balanced. Because if you look at the consumer, we have the least data on consumer today, but the super app gives us actually additional data points today that helps us to actually start to profile these consumers now. And the banks also are helping us on that front because so a lot of these consumers are not on the Grab platform, are actually opening customer deposits and using a debit card also to transact, which gives us more data points also at the same time. So we're getting all these different data points, especially as we expand our financial services product.
As a last question on that, do you see the fintech business currently and also in the future mostly as part of making the flywheel stickier, or is it part of being the main margin driver, which it seems to me it is supposed to be for some other businesses? If you compare, for example, Amazon and Melly, Amazon's AWS, Melly cannot build something similar, but they have fintech. So you would assume that the margin profile on that business is pretty important. I would assume it's similar for you.
Yes. If you look at the margin of our business today, mobility is somewhere around 8.5% from a GMV margin perspective. Food delivery is the most thinnest, which is pretty much similar around the world. You're looking at somewhere between 2.3%. Fintech, though, financial services, is where the margin accretion will come from in our business over time. But to do that, you've got to scale that loan book and balance that with the risk appetite. So over time, you will see, I've said to recently in an investor or a fireside chat that we've given out this 3-year guidance, $1.5 billion of EBITDA by 2028. How much is that going to be financial services? I said, you know what? It's going to be a good chunk of it because the margins in the business is high and we're scaling the loan book and we're quite confident with its trajectory to get there. So definitely for sure, financial services plays a key role without a doubt.
Well, so I want to just kind of paint some color around what really made Grab stand out to us. And that is, we look for profitability inflections in a lot of the businesses that we study and discuss on the show. And I have seldom seen a business with a more dramatic swing to profitability and operating margins than Grab, right? Negative 22% in 2023 to positive 3% in 2025. And 3% doesn't sound like a lot, but when you're operating at this scale and you're talking about a 25 percentage point swing in profitability in 2 years, that is incredibly compelling. And then at the same time, the headcount was essentially kept flat. So how did you do it? Is it just the magic of the super app?
Yeah, look, there's a few things that went behind that mix. The first thing was that coming out of COVID, we made a conscious decision to really invest in product. If you think back, you mentioned some negative numbers there, which is still painful to me. Those are scars. Those were the days when we did a lot of incentives, marketing, for an example. Now, what we wanted to make sure was as we're making for every dollar that we deployed, are those customers or even drivers and merchants are sticky on the platform. Now, we made a conscious decision to really invest in product and make that breadth and depth of the product so that we can actually start to focus on lifetime value. So it was a mindset shift change in terms of, okay, how do you harness with every customer that comes into the platform, every driver that comes to start driving with us, every restaurant merchant. So how do you harness that across the board? And that took some discipline because part of that is you dial back the marketing spend, you dial back the incentives that you give out, the promotionals that you give out. It was scary at first because it doesn't mean that the funnel will actually shut down. Actually, if you look at in 2022, 23, our growth did decelerate. It would slow. And we call it a cleansing moment where we say, you know what, maybe not every single user on the platform is of equal value to us. Maybe there is some users which are probably not probably is sticky enough for us to be in the super app where it could be increase the lifetime value. So we cleaned house to a lot of degree. And that was part of the painful mandate that we went through. And we rebuilt the product stack. And then we just focus on operating leverage in the business. We focus on cost efficiency. How do you drive that cost down for every ride that a customer takes? How do you make sure the driver is the most efficient? They're taking the most efficient route, that route. How do you, for every food delivery, how do you actually push it down? Because every minute counts in our business today. Every time a driver sits in front of a restaurant waiting for a food to get cooked is bad. Every time a driver is circling and looking for the next job is bad for us. So how do you drive that efficiency? And that's what we were really focusing. And that numbers that you just spoke about, the turnaround, so to speak, is really driving those costs, lowering that cost to serve, driving efficiency in the business. But also, we as a company also need to demonstrate operating leverage. So this is where we kept the headcount flat, we reduced some headcount also, and we just made sure that the business was lean in terms of driving more margin.
It was an incredible degree of operating leverage, as you said, and it really is quite impressive to see what you all have been able to accomplish. And one of the reasons why we like companies that are going through periods of profitability inflection, when there is sort of an ecosystem, a network effect, a proven flywheel, to use a bunch of jargon, is because a lot of that growth is sustainable and continues to compound, right? You can generally bet that a business like Grab's is going to only get more profitable as it scales. I know you don't necessarily promise that, but that's like, at a very high level, the structure. And so the reason that that's attractive, beyond the fact that, who wouldn't want to own more profitable businesses, is because very pragmatically during the growth phase, when you're burning cash, there is typically a reliance on stock-based compensation. And we certainly saw that and have seen that at Grab. But now you're going through this period of, like I said, that the cash flow profile is changing. The operating margins are profitable, and that puts you in a position where you can, wrap up a $500 million share repurchase program and announce that you're going to do another $500 million share repurchase program. And obviously that's critical to offsetting dilution, right? We've seen stock-based compensation come down from, 13% to 10% to 7%, but 7% is still pretty substantial. So how do you think about offsetting stock-based compensation going forward?
Yeah. So if you think about the profitability of the business, you just spoke about where last year we did $500 million in adjusted EBITDA, free cash flow conversion of somewhere around 50%. And what I guided Wall Street was by 2028, I will do $1.5 billion of adjusted EBITDA, so 3 times in terms of dollar EBITDA, and then free cash flow conversion increasing from 50% to 80%. So free cash flow roughly $1.2 billion. So that gives us, and then we just went through operating leverage and just growth in the business. At the same time, also, we've got to make sure the business keeps on growing. So a revenue CAGR of 20% is what also I'm guiding up the next 3 years. So we got that balanced view in terms of driving the business top line, as well as driving profitability and free cash flow. Now, in terms of capital allocation, which is whether you're doing buyback, whether you're doing M&A, organic growth, etc. And this is where I'm making sure that we are taking a very balanced approach. We're in the middle of our second buyback, the $500 million that you talked about. So by the time it's all said and done, it'll be $1 billion that we've deployed in buyback. Also, we've done a couple of few M&As that we've announced also this year. We think it's a great opportunity for us to take us to the next phase of our growth in a new market, for an example, like Taiwan itself. And also we've been focusing on organic growth by deepening and breadth of our product, but also using our balance sheet for those loans that we have, because it is retaining a high yield. So We will continue to see whether we want to continue to drive that buyback, continue to drive that dilution down. We kept stock-based comp flat. Now, if you can see the pattern of a dollar stock-based comp, it's been relatively flat on a year-over-year basis, and that's been really important. We're trying to keep our dilution to somewhere in sub 2 to 3%. Just keep it within that level, which is really important. I'm allergic to dilution as a person, so I'm going to make sure that we continue to drive that. So that balanced approach hopefully gives a shareholder perspective that we are trying to balance a lot of these things up, all these balls up in the air, because it's really important given the opportunity also in Southeast Asia where it's underpenetrated for us, especially in fintech where it's just been in this inflection point right now.
Peter, somewhat of a shift in the topic, but it's 2026, so no interview can go without the topic of AI. So if I would have to ask you, what is Grab doing, or how are you approaching developments in AI, agentic AI, all of those buzzwords?
Yeah, look, we're as a company, we've been so focusing on just, especially in the last few years in technology, innovating into the technology. We've been one of the first brave things that Anthony did was building our own maps. Like if you think about the effort required to map Southeast Asia, all these little alleys and all these roads which are completely messy and complex, we've had to map that, which is part of the operating leverage that we have in the business today. But that really, if you look at it, those are data points and algorithm and LLMs that we've built. And we also have accumulated more than 20 billion of data of customers, transactions, from our restaurants, from our drivers, from our customers also. So we have a lot of proprietary data at the same time. So for us, actually, AI from a customer lens and from a merchant and driver lens, actually, is how do we help them thrive in whatever they do? So we've deployed, for an example, it's like a co-pilot for a driver. So we want to get the drivers to not think about where to go next or which area should I go. Really, an AI interact with the AI so we can maximize your earnings in a day. That's been really fruitful for us. Half of our drivers are using, it's called Driver Coach, and they've been using it, and their earnings are up 20% plus, which is great to see for those who use it. We've deployed something very similar for our restaurant merchants. About half of our restaurant merchants are using it. And what's interesting actually to watch these merchants is their restaurant sales are up by about 18%, which is on a year-over-year basis. And actually they're advertising more on our platform, which is good to see. So we're actually benefiting also. We talk about people saying, okay, you're investing in AI, are you seeing any returns? Yeah, we're seeing returns from those AI, from those advertising revenue. We get more commissions as they earn more, or more food delivery, and more restaurant merchants are thriving. We benefit from it. And then just internally, we as Grab, we've got to continue to become like every other organization out there. We're also investing internally here to make sure that we become more productive, to drive that operating leverage that we talked about earlier, so that we can drive more margin in the business.
I feel like there's such a big eye on the companies that are actually developing the LLMs and are working with AI, and you immediately think of them. But especially these ecosystem companies that can use AI in every single part of their flywheel and their operations, who benefit a lot. I mean, I think about Meta as well, who's maybe not the first when you think about the LLMs, not the strongest one, but their internal use and what they see in advertising is just such a high ROI that it makes a whole lot of sense. And I could see how Grab is benefiting from the same thing. You also talked about mapping, which is, when I first heard about it and when we had the pitch in our show, just an incredible feature. And I believe it's a huge advantage also why you beat Uber, for example. But also when we think about Uber, it's such a controversial pick because people bring up AVs a lot, autonomous vehicles. And I believe that it will be incredibly difficult for any competitor and AVs to get into these local markets that you're talking about, where only you have the data for the mapping. So do you believe that you're shielded from AVs to an extent that maybe Western players are not, because you own the most important data in those local markets?
Yeah, well, it's actually given us a head start than anything else, because we have the data, we have the maps that we continue, and these maps are continually, every minute, every second is being updated, because we have drivers and walkers and cyclists collecting data points consistently while they're on the road. We do 10 million transactions a day. So with just all these different data points are being accumulated. So it has definitely given us a data advantage for sure, definitely. It's keep improved. I'll tell you a story because of the fuel crisis in Southeast Asia. We had to think through how to get those drivers to be more efficient on the roads per kilometer, right? So, and the only way to do it is you make tweaks to your mapping, to your fulfillment. We call it fulfillment routing. But the fact that you have your own map, you're able to do that instantly, very quickly, and without reliance on third parties. So it's given us definitely an advantage. Now, in terms of autonomous vehicle, I think Southeast Asia still has some ways to go before autonomous vehicles will be freely roaming around the road, just because the chaos of the road system of Southeast Asia. Singapore probably is the most viable city for now. And we have some cars actually on the road right now that we're operating. We're taking public passengers, but there will be some ways to go. But what we have is, and the reason why we're leaning in so much on autonomous vehicle in Southeast Asia is we have the customers already. They're on our platform. So they're using our services consistently. We have the data, also maps that we've done before, and we know how to operate cars. And one of the things about autonomous vehicles, actually, you got to operate these things. And we have a fleet of cars. We own 35,000 cars that we rent to our drivers. So we know how to do fleet operations. So that's a big advantage also that we have when AV is ready to scale.
If you would have to think about a timeline for Southeast Asia and AVs, how would it look? Because I feel like, in the Western world, and also depends on the country, here in Germany, things are moving a bit slower than in the US. But it feels like some of them, especially in San Francisco, they're already on the road. It looks like the future is already happening. What is the timeline that you see for Southeast Asia? And then maybe you can say, well, it's faster in Singapore than in other markets. So how do you expect to affect your business in the next, let's say, 5 years?
It will be still some time. Even within the first 5 years, we'll see, especially in Singapore, where the technology actually is getting much better. And we have done close to 60,000 kilometers already in Singapore, in a very small subpart of Singapore, in conjunction with the government, taking public passengers. So the cars work. It's very safe. We've never had any incidents. Now, I think one of the challenges of, say, in the Singapore government is how do we to make sure we help the drivers also transition, the human drivers transition to a humanless. So we believe actually it'll be a coexisting world at the end of the day, human and humanless. And I think where the majority will still be human-led ride-hailing services, but there will be these edge peripheral cases where the autonomous vehicles will actually supplement, where during peak hours, for an example, during certain times of the day when the drivers are taking a break, you want the robots to go out there and take over effectively so we can continue to fulfill services. Because today what you'll see is that when certain drivers change shift, takes a break, etc., search pricing goes up, demand goes up because we don't have enough supply, we don't have enough drivers on the road. I think these robots, these autonomous vehicles will actually supplement that in the future, and they'll coexist with human drivers. And that's the world that we see, especially in the markets that we operate.
One last question on that. What do you do with the entire fleet that you have if you are, these times where the search is not happening? Because, these up and downs, that was something that we talked about with Uber. And now you're saying you own a huge fleet of cars. So what do they do if the demand is currently not there?
Funny enough, actually, the demand is, for us, we've never had a situation where the demand, well, except for during COVID. When the COVID happened, mobility went completely to hardly anything. We had a lot of cars sitting in the garage. But that was kind of an unusual circumstances. But if you look at from post-COVID to today, our cars are all on the road. 95% of them, unless they're being repaired or being doing maintenance, etc. And what we're doing actually, we're transitioning to electric vehicles. You probably sound, Peter, hang on, you're not doing that in Southeast Asia? We're a bit slow. Okay, we're making that transition. So think about AV is like, whoa, out there. We're just doing the EV one right now. So we're transitioning a lot of our vehicles to electric vehicles over the next few years also as part of this. And that actually is another great warm-up for us to get into the autonomous vehicle at some point in the future. And we get to use Chinese EVs in our markets, which is kind of cool also. And they have some really cool technology. So we're making a transition. But AV will take some time. But our cars are being fully utilized right now out there.
Well, so when I pitched Grab to Daniel a few weeks ago, one of the things I was more excited about than I expected to be was definitely the fleet management services. But I had three big question marks, I would say, that prevented me from feeling comfortable investing in Grab at this moment. Which is not to say we'll never invest in Grab, but it was more transparency around the lending book, the stock-based compensation. I think you gave pretty reasonable and compelling answers for both of those. And then the third one to me is navigating the regulatory headwinds. I think you guys have done this as well as you can, but you face some real challenges, right? Like looking at what just happened in Indonesia, where you have this cap on take rates for, I understand it's for certain types of vehicles, but as an outside investor, you're asking yourself, well, it's only for two-wheeled vehicles, but in 6 months from now, is it going to be for four-wheeled vehicles? And where does this stop? And is it just totally out of Grab's control? Because there is, every country, every market is struggling with this kind of precarious balance between technology, gig workers, and the state. And it's not even across the US, right? Different states have different approaches. But when you're operating across 8 different emerging market countries, you get vast discrepancies in how they think about regulating and balancing those 3 very powerful sets of interests. So how does Grab think about navigating regulatory headwinds, and what can it do to mitigate those risks?
Yeah, it's definitely top of mind for sure, Shawn, because it is complicated in those 8 markets that we operate in. They're very different. In the last 14 years, if we've experienced many administrations that come and go also. And really for us is making sure that we are in partnership with them and we are building together. Because the mission if you look at the tagline of our mission, is to drive Southeast Asia forward. And for us to do that is we need to work with the different governments and also making sure that the social impact that we are providing to them also is meaningful and also is beneficial for them, because we are serving the underserved. And when you look at the 700 million plus of Southeast Asians, there's a lot of those which are underserved. Whether it's employment, whether it's banking services that we talked about, accessing transportation services, right, which they rely on Grab. So those are very important things. So our job is to make sure that we are continuing being in touch with the government and we are co-building with them. Hence why we do spend a lot of time and we invest in sufficiently also considerably in government relations as part of this. So we work constantly with government. So you highlighted an example there of the Indonesia issue, Indonesia 8% commission cap. And it's something actually we've been working with them now for a few months already in terms of how to navigate through that, because we understand kind of where the ask is. And we actually are supportive. We want our drivers to earn more, for sure, definitely also. But we also have to be conscious that the consumers also can't pay more at the end of the day. So how do you balance that at the same time? So we're working with them. We have a solution. We're working to make sure also all sides, the consumers are not paying more, the drivers are earning. Also making sure as a company also, our unit economics that continues to be healthy. But these are the type of things that we have to navigate and work with them. And the only way to do it is to build trust and to build a relationship with each one of them. So as the new administration comes in, we kick into gear and build those relationships.
Well, for as painful and difficult as it is to probably navigate these situations and maybe frustrating, I do have this very simple framework that if you create enough value for society will find a way to make it work, right? And so I think in the US and Europe, we saw this with Airbnb and Uber and DoorDash too, where there were various adversarial legislations that were proposed. You had protests, it was a controversial topic, but ultimately Uber and Airbnb and DoorDash made people's lives better. It provided new income sources. It provided, consumer surplus in the sense of the value of the services that were being provided. I would say the same applies to Grab. So, I know I mentioned the the regulatory picture gives me hesitation, but also if I'm thinking 20, 30 years down the line, I do think that Grab probably navigates these issues. And like none of these are permanent challenges, because ultimately the value of the service is so compelling that it'll win out. But with that, I think we're coming to our last two questions here. And so I'll do mine first, and then I'll let Daniel have the last word. But this is a question I've always wanted to ask a CFO, and that is, what is the one thing the public markets currently miss or undervalue about Grab on, let's say, a 10-year trajectory?
Yeah, I think the power of the super app is being underestimated. And we talked a lot about this super app since the beginning. And to a lot of because a lot of our investors are in the US, over 50% of our investors are US based. I think because they don't use a super app, and super app is not very prevalent in the US. So I think they miss the opportunity and the upside and where it can be unlocked even more and more as you add more product, as you add more user in the ecosystem, as you add financial services, the potential of that. And I think that's one part which I'm continuing to help educate, and being on this podcast with you guys. Thank you for doing that. So I think hopefully people understand a little bit more, because it is powerful. The data that you collect, actually, the data that comes through gives you so much ability to really understand the user and how you could actually help improve that user's life, and also help us also sell the right product to them at the end of the day. So I think that's one part. The other part is around financial services, because I think the financial services part in Southeast Asia is also in a point where it could be unlocked further and further, because there is still hundreds of millions of people who are underbanked and also just don't have access to financial services, which for them is one that they could, it's palatable, because you do have still a lot of off the grid financial services products out there, which are at very ridiculous interest rates. And we need to clean that out. And this is an opportunity for us to also transition those folks, as we did with drivers, from unemployment to being employment, and for those to move away from the off the grid loan system to actually on the grid loan system, because you'll help them build their credit history at the end of the day. So I think it's another opportunity for us that we are continuing to educate our investors.
I think what's easily forgettable is just how young the company still is in Grab. And you just mentioned it being a super app and many investors not fully understanding, perhaps in the West, what that actually means. I personally like to invest in the Asian market and look at it more broadly, just because I feel like there's so much opportunity. And my question is kind of to you, asking you, if you look 10, or maybe we talked about 10 years already, 20 years out, how do you see Grab evolve even beyond what you currently do? Or would you say that the businesses that you currently have, it's just about pushing them ahead because there's such a long runway left in Southeast Asia? Or do you see certain business opportunities that you could still basically create out of nowhere in the next 10 to 20 years? I know that Limited CEO, for example, said that if they become a $1 trillion company, it will be because of AI. You already talked about AI today, and we are value investors, so we don't really buy into these visions for 10 or 20 years. But do you see a way where you can utilize it, not only internally, not only to make the current business more effective, but maybe just build a totally new part of the business, maybe because your customers or your target audience needs it?
Yeah, I think over time, what you'll see is that we'll continue to add new products. If you look at in the few weeks ago, we had our product day called GrabX. It was in Jakarta, and we had revealed 13 new AI feature product services. So you will see that continuing to evolve and continuing to also widen our product stack. Our products will evolve more to be more AI driven. And I think part of that is, for me, when I think about what does AI driven mean, is that I think it's more personalized. Like the relationship between a customer and the Grab is more being developed to be more personalized, where I get to know you as a customer. I get to know you, Shawn and Daniel, what you eat, where you want to eat, what your calendar looks like. Can I order a ride for you now? How do you make that so that it becomes you're coexisting with Grab effectively? And we have all the data for us to drive that. And that product is evolving towards that. And I think more and more also, as we find operating leverage in the business, is you will have this coexistence between autonomous or robots, whether it's in a delivery format that we're starting to deploy also within indoor offices and potentially in indoor shopping malls, and also on the roads, also at the same time. So I think it's going to be exciting because as the technology continues to evolve, our product continues to evolve also to drive these new services to a customer. But I think the personalization is going to be a really important one over the next 10 years for us.
Well, it's a great picture that you paint. And I know for a fact that Daniel and I will be closely following Grab's journey forward. And yeah, it's an incredible honor, Peter, to have you on. And we very much appreciate your time. And yeah, thank you for being here.
Thank you very much, guys. Really appreciate it. Really enjoyed it.
All right. We'll see you all next time. Just a quick note before you go, this episode would not be possible if it weren't for our friends at Fiscal AI. It's our complete stock research terminal that Daniel and I use on every single episode and with every company we dig into, pulling 20 years worth of financials, digging into segment data, grabbing quotes from the latest earnings calls, and making use of real-time institutional grade data all in one place. And if you want to try it yourself, well, head to fiscal.ai/TIVP. That'll include 2 weeks of Fiscal Pro for free and 15% off if you upgrade to a paid plan. That's fiscal.ai/TIVP. Thanks for listening.
Thanks for listening to TIP. Follow the Intrinsic Value Podcast on your favorite podcast app and visit theinvestorspodcast.com for show notes and educational resources. This podcast is for informational and entertainment purposes only and does not provide financial, investment, tax, or legal advice. The content is impersonal and does not consider your objectives, financial situation, or needs. Investing involves risk, including possible loss of principal, and past performance is not a guarantee of future results. Listeners should do their own research and consult a qualified professional before making any financial decisions. Nothing on this show is a recommendation or solicitation to buy or sell any security or other financial product. Hosts, guests, and the Investors Podcast Network may hold positions in securities discussed and may change those positions at any time without notice. References to any third-party products, services, or advertisers do not constitute endorsements, and the Investors Podcast Network is not responsible for any claims made by them. Copyright by the Investors Podcast Network. All rights reserved.
The beauty of Uber's model is that the vehicles are not on their balance sheet, and drivers can opt to make themselves available in response to demand in real time. Thus, Uber drivers can be incredibly flexible about responding to ride requests and a lack thereof. Another way to maybe say that is that supply on Uber's platform naturally adjusts to demand. And for, say, Waymo, to try and allocate XYZ number of cars to a city that will displace Uber, well, the reality is that they're either going to under-allocate vehicles or over-allocate them at any given moment in time. There's just no way to perfectly match demand with a fixed supply of vehicles driving around, which is why it's better to deploy a more limited fleet and just partner with Uber, tapping into their network for bookings. And then the vehicles can be used for other purposes or as just an occasional alternative to a regular Uber.